Today we're kicking off with a new series looking at trading platforms, starting with Charles Schwab.
The company that invented discount brokerage in America bought its largest competitor for $26 billion and then deleted the cost basis records for some of those customers going back a decade. When users asked for the missing data, the answer was to guess. 7 million accounts were migrated. One user has been fighting a 60,000 discrepancy for over a year, calling for up to 2 hours at a time, 4 times a week. A 7-year day trader was blocked mid-trade while holding a position of over 3 million shares and had to call in for a manual override. The securities regulator fined the company $187 million for hiding costs inside its Robo-Advisor. A data breach exposed the social security numbers and financial account details of 55,000 clients, 12 trillion in assets, 28 million accounts. The platform millions trust with their retirement is the one with the most documented reasons not to. The company was founded in 1971 in San Francisco by a man who believed ordinary investors should not have to pay full commissions to trade. When the securities regulator deregulated commissions in 1975, the company had the model ready. First discount broker in America, early adoption of telephone access, online trading, and no-fee mutual fund platforms established it as the anti-Wall Street alternative for the next 4 decades. The move that set up everything that followed came in October 2019. The company announced 0 commissions on stock and fund trades. The industry followed within days. Every major competitor matched the price, but not every competitor could absorb the revenue loss at that scale. The largest independent rival could not. Within weeks, the acquisition was announced. $26 billion in stock, 7 million accounts, up to 1.9 trillion in assets. The regulators cleared it without structural conditions, no forced divestitures, no client protections written into the approval. The merger closed in October 2020. The platform that millions of active traders had chosen for its tools, its interface, and its independence no longer existed as a separate company. The professional-grade trading application that came with the acquisition was what made the deal attractive to active traders. The desktop interface, the custom scripting language, the options chain layout, and the real-time scanning tools were considered the best available to retail investors. The company promised to maintain the platform. It did not promise to maintain its quality. During the January 2021 retail surge, both the acquiring company and the acquired company experienced outages across their mobile and online platforms. The acquired company imposed temporary restrictions on the same stocks that the most prominent competitor restricted. The restrictions received less media coverage, but they happened. No regulatory consequences followed for either the outages or the restrictions. The migration happened in waves between 2023 and May 2024. The final batch moved 1.8 million accounts, holding approximately $350 billion in assets. A major financial newspaper ran the headline marking the end of the acquired platform as a standalone product. Users reported being locked out of their accounts for up to 4 days during the transition. By the time access returned, the complaints were already overwhelming. Cost basis records for purchases made before 2015 were deleted for some migrated clients. The company admitted it could not restore them. The suggested solution was to estimate. For users who needed accurate records for tax compliance, a guess is not a filing strategy, it is a liability. A separate user found that lot details showed trade dates they had never traded on. The data was described as completely fabricated. Another discovered that positions from multiple accounts had overwritten each other, converting long-term holdings into short-term ones with different tax treatment. A user whose account showed a 60,000 discrepancy after the migration has spent over a year attempting to resolve it. Support tickets are closed without explanation. The professional trading platform that was supposed to survive the merger has been described by its own users as degraded. Order fill rates dropped, price alerts stopped triggering or arrived hours late. A day trader with 7 years of experience was blocked from further activity while holding a position of over 3 million shares. The user had to call in for a manual override. That had never happened under the previous ownership. A market open outage in June 2024 left users unable to trade across all 3 platforms simultaneously. A second outage during a high volatility sell-off in August 2024 was attributed to a vendor issue. The company's own reported attrition rate was under 6%. The number is low because the users who stayed had nowhere easier to go. The ones who left lost the tools they came for regardless. The securities regulator fined the company $187 million in 2022 for misleading clients about its Robo-Advisor. The product was marketed as having no advisory fee. The hidden cost was a mandatory cash allocation of between 6 and 30% of each portfolio held in the company's own bank. The company earned the interest spread. Clients experienced the drag on performance. The regulator called it an undisclosed conflict of interest. The product still exists. The cash allocation requirement still exists. The fine was paid and the model continues. A separate $10 million fine in January 2025 was part of a sweep case for off-channel communications and record-keeping failures. The financial industry regulator fined the acquired company's entities a combined $1.05 million for trade reporting failures and callable securities. Disclosure violations. A data breach through a file transfer vulnerability in May 2023 exposed names, social security numbers, financial account details, and government identification for approximately 55,000 clients. The company disclosed the breach in July. No regulatory consequences have been reported. A user's health savings account was forcibly migrated and converted to a margin account without permission. A trade executed, the account went negative, and the system that should have blocked it did not. A separate user had the professional trading application execute an options trade when a stock trade was intended. The financial industry's own arbitration process found the company liable and awarded damages. The company markets itself as not participating in the order routing practice that funds commission-free trading on competing platforms. The disclosure filings tell a different story. The company receives payments from market-making firms for equity orders and options orders. The payments are structured differently than the competitors' arrangements, but the mechanism is the same. The marketing says one thing, the legally required filings say another. Schwab, for anyone who wants the scale, stability, and breadth of the second largest brokerage in the United States, where $12 trillion in assets, 28 million accounts, insured deposits through the banking charter, a professional trading platform that, despite its degradation, remains more capable than most alternatives, and a capital ratio 3 times the required minimum. During the banking crisis, give it a foundation no startup competitor can match. Accepting that the acquisition of its largest rival produced a migration disaster that deleted cost-basis records, fabricated trade dates, created a 60,000 discrepancy that remains unresolved after a year, degraded the professional platform its active traders relied on, generated outages during market hours, resulted in $187 million in fines for hiding costs inside its Robo-Advisor, exposed 55,000 clients' personal data and financial details in a breach, and markets itself as free from the order routing practice its own filings confirm it participates in. The company that democratized investing built an empire so large that when it broke 7 million people's accounts, it called the attrition rate acceptable. Every choice is a trade-off. At least now you know what you're trading.